guys, welcome back to the Capital Mindset Show. So today we're going to be doing a subscriber request. So be part of the subscriber request series. I think I have a total of about 70 left to go. So you guys kept them on coming. I'll be saying a couple comments about the totality of the requests. So in essence, I'm going to not be focusing on micro caps. If people submit micro caps, I'm going to technically, or not technically, but tend to avoid those unless there is a lesson to be drawn out from there that I couldn't draw out in another company. So I've talked about one micro cap in particular here on the channel, and I did so with the intention of kind of providing a lesson. It's specifically as a policy set forth now so that when the channel grows, I'm not having to change that later down the road because the audience will be larger, and thus I would have to be even further more careful with what I really say on the channel. And it's just setting forth responsibilities for myself and keeping myself accountable. So unless there is a specific lesson, an educational reason as to that microcap in particular, I will be avoiding it. But thank you so much for providing those requests. I will, of course, feel free to submit them if you think there's something to learn from them, but that's as far as that goes. All right. So basically the company that we're going to be talking about today, I'll just pull it up here on the screen, is this company, right? So I won't even try too hard because it's kind of early for me to pronounce this name. But you know what? Let's give it a try, and you guys can make fun of me. Schweitzer. Okay, I think I did that. Okay, correct me down below. Okay, and basically, this company provides engineering solutions for products. They work in the material space, and the lesson that I want to hammer home today is be very careful or very wary in things in the material space at the current time. Okay, that doesn't mean that they're bad businesses, not necessarily. It's a little more nuanced than that. It's that in the present time, when we have material price inflation, you want to be wary about these kinds of businesses because the margins might be squeezed. And we'll actually take a look at that in the model and see that. All right. So going over to the investor presentation, let's kind of see what they highlight for us. And again, this is the sales pitch of the management team, right? So if we don't like what we see here, we're probably not going to like too much most of the time. Very rare instances we'll see something, a bad presentation, but then underlying is really good. Usually this is nice, and then the actual numbers are eh. So taking a look over here, you can kind of see what they're more or less involved in. And this gives you an overview or an idea of what it is, the scope of this business, et cetera. So that's, again, why we look at these, right? To just get that general overview. Then this is kind of more specific stuff that they do. So you see coding, converting packages, innovation development. So this is where you start to gather your idea of whether or not you understand this business. And this actually will drive further down the road when you do your valuations, what kind of discount rate you're going to use, or whether or not you want to be involved with this business at all. Because again, we want to avoid businesses we don't quite understand, all right? And then we go down over here, okay, more further explanation of some things. So again, highlighting that they are engineering different products, right? Different materials that are used in products that you may use. And then again, hammering home for me, I would be cautious about this because we're seeing material price inflation. So, okay, they're the industry leader. Okay, of course they're going to say that. They might be. We'll see. All right, so a little bit, some numbers right here. Free cash flow of 128 million. Okay, this is for 2020. So there's a reason why I'm saying that. So 2020 was 128 million. We'll see what happened in 2021. Look, they're highlighting EBITDA. You shouldn't really care too much about EBITDA because, again, interest, taxes are actual expenses. They are material to you as the investor. Depreciation and amortization are material expenses. You have to continuously invest in your business. Otherwise, the business won't be around for much longer, or at least in the position that it's in currently. So again, I think I've addressed in the past basically what are the problems with EBITDA as to how investors use it. And there is a space for EBITDA to be used, but it's just misused horribly in the modern industry. Okay, and I can make a video just on that if you guys want, just let me know. Okay, so strong margins, cool. You know, of course they're going to say that right now. Strong margins. We'll be the judge of that. This is 2020. They haven't released one for 2021. Okay, so it looks like we're going to skip through this and we're pretty much done. Okay, so actually let's go through here. So they go work in water, air and processes, auto, paint, protection, cool, healthcare. So this is kind of, again, giving you that idea of all the scope of what they're doing. And then they're going to talk about their papers. All right, so I think you guys get the idea. We can move on to the model. So I already plugged it in here, and ignore some of these actually. So this is not going to be there. Let's take that out. And we're discounting it right now at 20% margin. So we have a decent margin of safety at the moment. Let's take a look at some of these numbers right here. So analysts say it's a strong buy with 87% upside, potential upside. So if that's what you guys want to listen to, there they are. And then we'll take a look ourselves at the ratios right here. So because we want to take a look at those margins, see what they've been doing. So taking a look at the liquidity ratios. Okay, decent current ratio. Okay, that's pretty good. So basically what this tells me is they have enough current assets to cover their current liabilities. However, we have to be kind of careful with the current ratio. The cash ratio is a way more conservative measure, but I don't ding them just because they don't have enough cash to cover current liabilities. That's not necessarily the case. It's very conservative. So I have basically the basic one and then the most conservative ratio there for us to look at. Let's take a look at the total debt ratio. So they have been incurring more liabilities. I can see here in the long-term debt ratio. They basically what this is telling me, remember, we're drawing stories from the numbers. We're letting the numbers tell us what's going on. They are taking on more debt over time. Okay. So we want to see this going down ideally, but it's going up. And then I know, for example, and this is the case where even in preliminary analysis, you got to understand some nuances about what's going on in the business. They did an acquisition, and that's more or less what's driving the change here. So then let's remove that acquisition for just a moment. And then let's see what happened with the management team. So the management team has been deleveraging, right, for the most part. And then all of a sudden a big spike up. So then now we have to consider whether or not that actual acquisition is going to be accretive to the business, or over time, is it going to be a failure? Okay, so that's yet to be seen. But what I do see here is a decent amount of debt. And then we'll actually look at when we get to the summary report, I'll highlight another thing that kind of shows how much debt they have. So long-term debt to capital, yeah, this should be going up. I mean, should be going down, but it is going up, and it should be going up because we just talked about the debt. Debt to equity also should be going up based on what we've seen, and it is. Then gross profit margins. So these are the margins that they were touting. So yes, they had high margins in 2020. That's what they said in the investor presentation. Do you see the sales pitch here? So 2020, high margins. 2021, margins drop. Okay, margin dropped to the lowest point in all these measured years, right? What happened? Material price inflation, right? So the materials that they use, right? Who's benefiting from that? So then now this kind of drives my mind in a different direction as an investor. So remember on the channel, the position Rio Tinto and BHP, well, those were benefiting because they're on the other end selling the materials as an example, right? So the margins on these guys are going to be dropping, right? So that's something we can think about, okay? And whether or not that will continue, that's a big question you have to ask yourself if you're thinking about getting involved in a business like this. What's going on with the margins? Because again, and then if that's beyond our understanding, then maybe we shouldn't be involved in a business like this, right? Because that's a risk, and you have to understand the risks are far more important than the potential upside. Far more important to understand the risks. And this is, again, why investing sometimes is not so easy, right? So operating margins, right? We see that coming down. We see the same story. Net profit margins coming down. ROA obviously would be coming down. ROE coming down. So everything is basically decaying in the DuPont analysis, right? And by the way, that's what this is. This is simply a DuPont analysis, okay? Very straightforward. Let's take a look at some of these other ratios down here. So we see the earnings quality is actually pretty decent. Okay, this is a measure I use here on the channel. It's supposed to measure companies or management's ability to, or their accounting abilities, basically. And it tends to be that good businesses have good earnings quality. Okay, book value per share for a business like this, it's interesting to note that it is just 50% above book value, or around 50% above book value. It's not something I'd really take too much credence to, but yep, there it is. And then let's take a look at these inventory ratios. Okay, so the inventory ratios is okay. I really want to pay attention to the cash conversion cycle. So cash conversion cycle has gotten weaker. We want to see this getting lower. It's gotten higher. Basically, what it means is it's taking longer for them to get the cash from the sales that they made. So let's say you make a sale with me, and then I'll give you the cash in 99 days from now. That's basically, in a very basic understanding or explanation, what's going on, right? And then the lower that is, remember, time value of money. $1 received today is more valuable than tomorrow. So you want the money as soon as possible. And it kind of can give you an idea, remember, drawing stories from the numbers, gives you an idea of how powerful that business is within the transaction. Okay, so I remember this video we did on the food companies, right? And PepsiCo, among the food companies, had the lowest cash conversion cycle. Well, that tells you PepsiCo has a lot of power in the negotiation. Okay, so coming back to the here, I want to highlight this. So we see the enterprise value is about $2.2 billion, and then the market cap's $1 billion. So that already right there is telling me a lot of debt, decent amount of debt. And then, okay, the model's analyzing the business for me and telling me it's debt heavy. We have decent estimated WACC. Okay, there's some different calculations to that WACC, by the way. And then the dilution accretion, not so good, basically. So what that means is if they have been diluting, which they have, okay, that's the key. They have been diluting. How has that affected the per share performance in cash flows? And then that's basically, it's returning a negative, which means we are not experiencing accretion, okay, which is very important, because I'm all good and I'm fine with some dilution depending on what the cost of capital is or what that's doing to the cost of capital, as long as that's actually adding to the value of a per share basis, which is very important. Okay, so taking a look over here, let's assume some growth rates. So they've had growth of about 9.9% per year. We don't really need to, I think it's just a margin problem, if I'm being honest. So let's assume that they continue this level of growth, and let's go with a 10% down the middle, right? So already we're starting off to a bad start, but let's say they improve margins, and the margins improve by about 20%. Okay, so basically, maybe my discount is too much, but for me, this discount I think is appropriate. And then let's say they go a little crazy, right? All right, so 20%. And then let's go a little bit lower. But I think I made my point here. At a 20% discount rate, if you want a high margin of safety, this isn't at the right price. But let's lower that to 15%. So with a 50% required rate of return, we're still implying above market average returns. And however, I'm actually not assuming dilution, but that's fairly low dilution, which again does harper back to the idea that this company does utilize more debt than actual common stock in order to fund new acquisitions. So I'm going to leave out the dilution for now. So at a 15% required rate of return, this still looks quite expensive. I'd have to probably assume, let's change this to 15%. Okay, we're getting close, but we're still not there. Then if we do a 12%, which is slightly above, now we're lowering our margin of safety. We kind of really have to understand this business and really understand when is the opportune moment to buy if we're implying around a 12%. So in that case, a 15% growth rate would be adequate. So let's actually make that the high, and then let's turn this into a 12 over here. So we're actually very close. So at a 12% growth rate, that implies a normalization of margins around that, right? Close, between 12 and 15%. That's a normalization of margins and the continual growth rate of 9.98% that they've done. All right. So if you think that's possible, then okay, you can probably get there. But what I'm seeing here is this business, while it is interesting to see that they're involved in so many different things, it's not at the right price where I would say that I have a decent chance of beating the market. And again, I don't want to add things, even emotion aside, you got to remove the emotions out of it. You may really like a business. You want to add positions to your portfolio that you believe, based on reasonable analysis, that will outperform the market. Otherwise, why would you add it? All right. So then your opportunity cost is simply just to buy the index, right? And then there's nothing wrong with buying the index, by the way. So you should think about what is the opportunity cost at the end of the day. Okay. And if the opportunity cost or the margin of safety between the individual company and the market as a whole is not very large, you're then taking on a lot of risk. You may not think of it that way. You may think it's a low risk business, this is a blue chip. Well, you are taking a decent amount of risk because you have to measure risk also with opportunity cost. Okay. So with that being said, I hope you guys enjoyed this quick preliminary analysis on this video. Some videos will be a little bit shorter. Again, I'll try to get the videos in a way that if there's a lesson to be had from them, I'll highlight those lessons. Again, with the micro caps, if you guys submit micro cap requests, I will most likely not do them unless there is a specific lesson to be had from them, or there's something incredibly unique about them in the particular moment that they're recommended. So with that being said, guys, thank you guys so much for watching. If you guys like this kind of content, please feel free to leave a like. Comment down below if you have any questions, that things I didn't cover, or make fun of how I pronounced the name at the beginning. And if you guys have any further requests, you guys could leave them down below. I tried my best to respond to all the comments as quickly as possible. But other than that, guys, thank you and have a good one. Bye.